Hi, everyone. My name is Matt Reynolds, EVP at Newport Private Wealth. Today, we're pleased to bring you an investment panel discussion on 2021 risks and opportunities in the marketplace. Joining me here today are co-founder and chief investment officer of Newport Private Wealth, Mark Kinney, Achilles Taxildaris from Bristolgate Capital Partners, and Richard Jacobson from Golub Capital. Mark, why don't we get started with you? Thanks for joining us today.
Thanks very much, Matt. Happy to be here. I wish it was in person, but that's the way it is now.
It would be great to do anything in person, Mark. I thought we could start off our discussion today by just highlighting our investment process for those who aren't familiar with us.
Sure, Matt, I'm happy to. What you see on the screen here is the heart of it. And really, it comes down to a couple of things. Number one, what's in a portfolio? And number two, how decisions are made. We believe a portfolio containing public and private assets has a much better chance to outperform a portfolio of stocks and bonds over a market cycle.
Can you expand a little bit on how that has worked out for our clients over the last decade?
Sure. Over the last 10 years, all 5 of our mandates have managed to outperform their benchmark with less risk. Given that it's been a bull market for stocks and bonds, we feel very good about our outlook for the next 10 years.
So we often get feedback from advisors that our decision-making team and our process is unique as well. Can you delve into how portfolio decisions are made and why we do it the way we do?
Absolutely. It all starts with our investment committee. Today, we have 12 people on the committee, and our job is to make a call on the world, make a call on all the asset classes, and then design the portfolio that we think is best suited for the current environment. We then stop there and go external from us and hire managers around the world that we think are best suited for each of those asset classes. Evidence of that today is 2 of the managers we have with us. The first one, Achilles Taxildaris of Bristolgate Capital Partners, is a US equity specialist. We recently hired them because we wanted to have more exposure to US equities, and our previous manager had volatility higher than we were comfortable with. The second manager, Richard Jacobson from Golub Capital, is a new asset class, private debt, that we've been recently increasing our exposure in.
I want to focus in on the first part of that, which is setting asset mix. Before we get into manager discussion, I think a lot of our attendees are wondering about positioning client portfolios heading into 2021. I think you did a great job in the Q4 video for anyone out there who needs to watch that. It's a great update on what our investment committee is thinking. Mark, I thought for purposes of this presentation, we could hit on just some of the highlights of what you covered in that video.
Absolutely. We all know it's a challenging market out there, and it will continue to be so for this year. However, despite this, there are pockets of opportunity that we see. Private debt is one of them, and you'll hear more on that later. REITs is another. That asset class sold off a lot in 2020 and has yet to recover. And lastly, private real estate we also have comfort in. On the public side, we expect equity market participation to continue to broaden, which we're well positioned for. Lastly, we have cash available to add to all asset classes should volatility increase.
So Mark, one of the key differentiators of Newport has been the ability to uncover lesser known or harder to access strategies within an asset category. You can see on the slide, there's a number of ways that we manage risk in finding and evaluating managers. I was hoping you could expand on how that process has evolved over time.
Sure, Matt. As our assets have grown, we've been able to expand the depth of our platform dramatically. Some of the things that we also look for are the fit with our current portfolio, the ability to manage through market cycles in both good markets and bad. And we like owner-managed firms. We like their capital to be invested alongside ours.
So, Mark, obviously a ton of due diligence we go through with every manager before they get onto the platform. Why don't we turn it over to you now to play interviewer? You brought some fine speakers with us today. Take it away.
Sure. Achilles, thank you very much for being here today. Can you start by just giving us a brief overview of your firm and your strategy, because it is fairly unique in the marketplace?
Yes. Hi, Mark. Thank you for having me on this panel. I'm happy to talk about our firm. So at Bristolgate, we developed a strategy that is focused primarily on high dividend growth, delivered by concentrated yet resilient portfolios. And our strategy differs from our competitors in three main ways. First, through our own research, and as you can see on this slide, we identified that the highest dividend growth is an attractive sandbox to look for ideas. There are many dividend strategies out there and many others that actually focus on dividend growth, but we're different because A, we're forward-looking. We try to predict what the dividend growth is going to be for the next 12 months. And we are agnostic to the current yield. Instead, we care more about the yield on cost. The second reason we are different is because we combine human and machine to generate our growth predictions and pick companies for our portfolio based on fundamentals. And the third reason is we're high conviction, building concentrated portfolios of 22 holdings that are equally weighted, but they're also very well balanced and resilient over time.
What's your view? Obviously, I mentioned there's lots going on in the world, lots going on in the stock market. What's your view on the current environment and the opportunity set for 2021?
Yes. So, I mean, 2020 was a year, as you mentioned, of a very high concentration of returns. Apple, Amazon, and Microsoft accounted for almost half the S&P 500's total return. The next 7 companies, which only one of them pays a dividend and that's not growing, are also all IT stocks. And combined, they account for 77% of the index returns. So what comes down to it is in 2020, diversification hurt. And we have seen in 2009, similar to today, the concentration of these market returns that was high, and the aggregate dividend growth in the index was also very low. So as the economic recovery broadened, the subsequent dividend growth of our strategy was amongst our best in the following years, like between 2011 and 2015. So currently, in this environment, we believe that in an optimistic scenario where vaccines and the stimulus and the savings of the consumer are the seeds for a broad economic recovery this time around, we believe that the rally in the tech stocks that we've seen in 2020 will broaden in 2021. And that will create opportunities to produce higher dividend growth and will also expand going forward. So in 2020, our portfolio companies at year end, on average, they delivered about 15% dividend growth. That was well ahead of the S&P 500 dividend increase that on a cash basis was almost flat. And looking forward, including the changes that we made to the portfolio subsequent to year end, our expected dividend growth on companies in the US strategy is 14% in 2021. And this compares to near zero growth consensus and dividend futures are implying for the index itself.
Thank you very much. I always find it interesting or easier to comprehend if you can give a specific example. And obviously Home Depot's been a favorite stock of a lot of people that we've been homebound. So tell us about why you like that stock.
Yes, so Home Depot is a long-term holding for us. And while most of the dividend strategies focus on current yield, we focus what we believe the company will be able to deliver in terms of dividend growth. So we purchased Home Depot like 6 years ago at a current yield of 2.1%. That was below market. Over the 6 years that the name has been in the portfolio, it has delivered over 20% annual dividend growth. And the interesting piece is that the current yield now is still around 2.3%, implying similar capital appreciation over the same time period. So the important piece here is that the yield on the original cost of the holding is now well above 5%, which is much higher than the yield that a typical dividend strategy is offering in and around 3%, let's say. So that's kind of like the model that we hope to achieve on all of our holdings. And we believe that when dividend growth actually comes from, is sustained by strong fundamentals, appreciation of price tends to follow that dividend growth. And the investment thesis on Home Depot is they're the leading home improvement retailer, and in a retail world that is dominated by Amazon and online, they have a model that is unlikely to be disrupted by Amazon. You kind of have to go into the store to check the materials that you want for home improvement. And they're doing an excellent job on the omni-channel, and we believe that's key in today's retail environment. And finally, we think while it had a very strong year in 2020, as working from home became working for home or improving the home, Home Depot did the right thing to reinvest in their business. They spent some money to give back to their employees, and they could have used that to return it to shareholders or just simply show improved margins. But we appreciate what management is doing, investing back in their business because they're thinking the long term. And we continue to be, believe in the thesis of the name. And we also think there's a significant opportunity on the professional segment to continue driving growth and margins for the name.
Next up, we have Richard Jacobson from New York. He represents one of the investments on our private debt platform from Golub Capital. Rich, thank you very much for joining us today.
Of course, thanks for having me.
I think a natural question on a lot of people's minds, because it's a relatively new asset class, especially for Canada, is, what exactly is private debt?
Sure. And it's interesting because I was thinking about before the best way to describe it, and I would almost say it's analogous to, when someone says hedge fund today, that means a lot of different things. And I think that's what's happening with private debt, private credit. It really does mean a lot of different strategies within it. And so if you look at kind of what we would define it today, it would be things like mezzanine financing, junior capital financing, stress lending, distress lending, direct lending, obviously, which is what Golub does, with private equity sponsors, with non-sponsors. So it's a very large basket today when people kind of use the word private, private credit, private debt.
And so Golub's specialty is what?
So our specialty is, and as you know well, after all the time we spent together, we are a single strategy manager. And I tell people we do one thing and one thing only. And that one thing is we provide debt in partnership with middle market private equity sponsors for buying middle market businesses. So if you think about kind of the leverage buyout as being the descriptor, we're providing the L in the leverage buyout. So a private equity firm finds a company they want to buy, they negotiate a purchase price, they write an equity check, and then they're going to look for a debt provider to provide them with the remaining part of that purchase price. And that's what Golub wants to do. We want to be the sole or lead lender in those transactions.
And Golub's been around for a long time and is one of the leaders in the industry. Tell us about where you fit in all that.
Sure. Yeah, we've been around for over 25 years. Today we manage about somewhere in excess of 35 billion in capital. And we are probably one of the lead premier middle market players within the space. We obviously have some competitors, but I'd say we're certainly considered one of the top 3 middle market lenders. Very much driven by our history, our size and scale, and in our historical performance.
So 2020 was obviously a challenge to many businesses, many investors. How did you guys hold up in 2020, and what's your outlook for the market today for your space?
Sure. Yeah, I'd say it was 2020 was a pretty crazy year for everybody. Interestingly enough, our Q1, like most managers, we had unrealized losses for the quarter, and it was very much reflective of the fact that there was a lot of uncertainty around in terms of how COVID was going to impact our portfolio. Fortunately, kind of after that Q1 and the reopenings of the economy in May, And frankly, the ability of our underlying portfolio companies and borrowers to adapt to the environment and respond, we saw a significant reversal of those unrealized losses and ended up having a very strong year in 2020. Don't want to take a victory lap yet because this COVID pandemic still has a ways to go, but certainly we feel much better today about the portfolio knowing what we know today and the information we have than we did back in March when everything kind of started in earnest.
Thank you. And much like I asked Achilles, is there an example of a company-specific loan you can think of just to give people a better example of how you participate in the industry?
Sure. Yeah, I was thinking about what would be an interesting example of that. Back in the third quarter, we financed alongside a private equity sponsor is buying the business, a very distinctive fast casual restaurant franchisor. And the reason I chose it is actually, it's kind of interesting, right? Because you're thinking COVID and restaurants, like, wow, why would you want to finance a restaurant business in the middle of COVID? Well, interestingly enough, we're partnering with a strong sponsor, but more importantly, if you look at the credit attributes of the business, very resilient business model. After the COVID impact, the business had same-store sales growth quarter over quarter, after that March quarter. Historically has had only about 25% of its revenues from on-premises dining, and historically has had 6% quarter over quarter same-store sales growth. So a business that we thought was from a credit standpoint was a good business to finance, and a pipeline of over 500 additional stores that could be opened along with the sponsor buying the business. So again, just a situation where the sponsor identified the business, wrote an equity check, and asked us to provide the debt financing to close the transaction, and that's how we handled it.
And as the senior lender, or usually the senior lender in cases like that, you would have that equity behind you supporting your position, obviously.
Yeah, and that's, and I'm remiss, I should have mentioned this early on. We were talking about our strategy and confirm that we are a first lien senior secured lender. So you're absolutely right. When you think about the capital structure, Golub, we are at the top of the capital structure, and we have all that equity capital underneath us. So from a lending perspective, we think it's important, and frankly, it's why we've chosen to partner with private equity sponsors, right? You asked the question about how 2020 went. A big chunk of the success that we had in 2020 was the fact that we had private equity sponsors supporting the businesses that we were senior in the capital structure to, and that for us was proven out throughout the year, and the reason that we've continued to choose to lend really in partnership with private equity sponsors.
And last question, but on a deal like that, the restaurant one, what would the coupon or interest rate be that you would charge in a deal like that?
So today you're seeing these are middle market illiquid loans. So you're seeing spreads anywhere from LIBOR 450 to LIBOR 600, depending upon the kinds of transactions. All of our loans in the middle market have 1% LIBOR floors. So for your participants in the conference, to the extent they're trying to figure out what our yields are, if we're charging LIBOR plus 450 on a loan, and we have a 1% LIBOR for, we're actually getting 5.5% for that specific loan, because even though interest rates in LIBOR is below, at 30 basis points, we're having a LIBOR floor of 1% that gets added into that yield.
And to provide context, that would be about 5.5 times what the yield is on the 10-year right now. So obviously you're getting paid for the work you do, and that's why we like the asset class compared to the conventional bond market.
Thanks, Mark. And a big thank you to Achilles and Richard for joining us today. If anyone would like more information on the topics discussed today or about Newport in general, please feel free to get in touch with either Amelie Beauregard or myself with the contact information on the screen. Thanks everyone for attending, and stay safe.